Hi there, this is James Turp from Absa Asset Management, bringing you your SARB MPC outcome update for today's May 2021 MPC meeting. So coming into this meeting, off the back of March, where we had that unanimous 5-0 vote for no change to interest rates, and we were coming in looking for any change to the timing expectations of rate hikes, as well as any change to the inflation and growth forecasts. So those have been important. And coming in, the market was pretty much prepared for a reduction in inflation and perhaps a slightly more hawkish comment given the picture of global inflation. So getting right to it, the first comments were made around the vaccine rollouts globally and how growth projections have improved as a result of this, and optimism as well. Commodity prices have been rising, as well as the rand strengthening 4%. So some really positive factors highlighted there. Then when it came to the inflation forecast, some rather interesting moves. Firstly, headline CPI moved down to 4.2% from 4.3% at the previous meeting, but left unchanged at 4.4 and 4.5 for 22 and 23, both at the middle, basically, of the target range. When it comes to core inflation, though, for the year 2021, moved down to 3% from 3.3, so rather big adjustment there, keeping 2022 and 3 the same at 4 and 4.3% respectively. Now, on the growth side, a big revision to growth for quarter one, moving it up to 2.7% from previously being a negative 0.2%. So a big adjustment for Q1 there. And that brings annual growth up to 4.2% from 3.8%. So what are we looking at? Growth looking even better, particularly in the short term, and inflation having moderated lower over the short term or over the next year, as well as inflation expectations having moved down and being anchored closer, if not below, the midpoint of the target band. So all looking good for monetary policy there. Risks to growth determined to be balanced. Risks, however, to inflation have changed, and those are marked to be at the upside. So risks to inflation changing from balance to risks being up. So that was probably the highlight there from the hawkish commentary. Now, he also refers to negative real rates a lot, of course, and he talks about advanced economies remaining highly accommodative. And with uncertainty this year around inflation returning and about where interest rate policy will need to be set globally, of course, in developing economies who haven't taken advantage of these accommodative rates, they're going to need to normalize quickly to keep capital flows stable. And this perhaps a reference to our own negative real rates approaching negative 1% at the moment. So then we come to the quarterly projection model, and this is pretty much unchanged, a few basis points higher over the 1 and 2 year area, but it's still expecting 50 basis points of hikes this year and 100 next year. And this year's hikes coming in Q2 and Q4. So another reference made was that rates are still highly accommodative in South Africa. And with that, combined with the risk to inflation at the upside, almost preparing investors that, hikes are certainly going to be around the corner, not necessary at this meeting, though, with a unanimous 5-0 vote to keep rates unchanged. So on the balance, the market has reacted with a little bit of optimism, with bonds moving positively and the curve steepening slightly as perhaps not as hawkish a commentary as perhaps some market players had expected on the back of the Federal Reserve Bank's FOMC minutes released last night. So, yeah, that is pretty much the gist of the MPC here. And of course, saying that any future moves remain data dependent and that they will look through short-term shocks and focus on second round effects. So consistent with previous commentaries there. So on the whole, a good MPC, inflation lower, growth higher, and rates unchanged. good for fixed income investing. And what this means is that if you look at what the market's discounting at the moment, for that forecast period, it is completely in line with the QPM at the moment, which means investing in an income fund right now, you are getting the benefit of those hikes being priced in. So where we have funds like our core income fund running along at a yield of around 5.5% before fees at the moment, that is showing considerable value considering that the fixed portion of that fund is discounting those interest rate hikes. So good for fixed income investing and a good meeting overall. Thanks very much for listening. I look forward to speaking to you again soon. Thank you.